Hello viewers, today let's talk about value investing and different approaches how we could value companies, because as it was established that value investing probably is the most known and most effective ways how to invest, because in fact everything is value. We established that before because we have presumptions that we are buying something that will be worth more in the future, so everything is kind of value investing. But let's go over this rather simplified definition and see whether there are actually different ways how to value companies and, so to speak, different value ways to be value investor. So yes, let's go to basics and look at intelligent investor and its author Benjamin Graham and what he told it about. I wouldn't over review the book because this will be probably topic for a different video. I would just say that I would subjectively say there are two schools how to do that, how to approach value investing. One thing is to look at company's ability to generate cash or profit in future, and that will be discounted by appropriate interest rate depending on many factors. And this is the theory which is more common, and this is used by analysts and portfolio managers and investors out there. And it's kind of obvious because you have to see how much company is able to generate cash in its existence, and then you have to discount it with appropriate rates. So all theoretical risks are there, and if there is wide enough margin, it makes sense for you to buy it. That's one way how to do it. And second way how to do it is to simply see at companies' financial statements how much company's liquidation or book value is and whether it's higher than its actual market price. Now, the second approach is way simpler and way easier to understand, because you could simply see that if company has something in its balance sheet and it's higher than it is on its market price, this is kind of no-brainer. And here's the thing, how many companies actually are there? These are extremely rare examples where companies have extremely low price to book values, or their current assets are minus liabilities are higher than their market price. It happens very rarely in modern markets. But why I'm saying this, because actually Benjamin Graham invested in that way. He only looked for the companies which had I didn't recall how he had its method where he calculated its proper value based on its balance sheets, current assets and liabilities, and he saw that if there is significant difference between that and market price, he will just simply buy it and make some quick profit. And in fact, Warren Buffett does the same thing in 1950s when it first made his returns, because at that time markets were rather underdeveloped, and he could simply spot those opportunities because he was looking for them. But as the time progressed and markets became more efficient, these kinds of things went to be non-existent, and you could see them only in extreme times of crisis. So what actually Benjamin Graham is saying, that to determine value, investors use fundamental analysis mathematically by multiplying forecasted earnings over a certain number of years. A capitalization, a factor of company. Value can be determined then by compared to actual price of stock. Kind of obvious, right? Then there are 5 factors that are included in determining capitalization factor, which are long-term growth prospects, quality of management, financial strength, and capital structure, dividend record, and current dividend rate. To understand these factors, value investors look at companies' financials, such as annual reports, cash flow statements, and earnings before interest, tax, depreciation, and amortization, and company's executives' forecast and performance. You have heard this from anyone who is talking about value investing. But let's see how he actually invested, because maybe Warren Buffett could tell us that, but it's in his books. I don't want to open his books, but actually he told his approach as someone as used cigars. I remember that Warren Buffett called that approach when you see companies which actually were not the companies which actually were not defined as where is that? Yes, there is that. There is actually this theory when determining value by using these factors, but Benjamin Graham actually didn't do it. As I told you previously, he actually simply looked at companies who had like very good balance sheet and book value was higher than the market price and bought them. And Warren Buffett called them as almost used cigars. He basically give the allegory between someone who found unfinished cigar on the street, had a few puffs and then dropped it. That was his comparison to this kind of approach. It worked for a short amount of time and it made some gains. But as I told you before, markets became too efficient and it actually lost its use, unless we are talking about extremely severe market crises when these kinds of opportunities go into fashion again, because simply markets provide us with them. But anyways, there is one approach which is very similar, very simple, which is to find companies beneath their book value or their current assets. That's more extreme example, and to buy them because they will have that margin of safety that company's liquidation value still will be higher than the stock price, so you are looking at profit. But if you cannot find these extremely rare opportunities, you have to do like common way to simply see how much money business is generating, discounted this with the interest rates, and basically compare yourselves to like 10,000 of other analysts and portfolio managers who are doing exactly the same thing. So actual theory is really simple and straightforward, but to execute in the way that you are able to beat the market with reasonable margin is very tough, because everyone knows that and everyone is using that. So what to do? See my next videos or see my consultations, and you will know some angles how actually realistically beat markets also after peace. So let's continue this topic in next videos, but now you see that there are two ways how to do that, and each of them is not that easy. Stay tuned.